Okay, so back with Garrett from Gaylord Hansen team, and so we've talked about how do we qualify the borrower. Now we're going to talk about the property. So okay, so scenario is, I'm working with a couple, send them over to Garrett to get pre-qualified. They get pre-qualified. We go out and find that right house, and thank goodness we get our offer accepted. And I get excited to call Garrett as a real estate agent. I'm going to send him over the contract so he knows what we've agreed to and so forth. But he's already got all the borrower's information. So you're already working on the borrower's side. What do you do from the property side to make sure the property is appropriate for your loan?
Yeah, absolutely. Let's stick with this kind of scenario just so we can dive into timelines for you. So at this moment, right, you and Kevin are super excited, got the offer accepted, and probably in a very tough market right now. So awesome. You're going to go through with Kevin the first 3 days, kind of probably go through inspections. And what that inspection for you is a private inspection that you would pay for directly out of your pocket. That's the only expense you're typically paying for directly out of pocket, that and your earnest money deposit. But all of that does go towards your closing at the end of the day. So I'll explain in short. That personal or private inspection that you're doing is probably the most important one for understanding the bones and the skeleton of the property, right? And he would know a lot more of this than me.
So
He's
generally,
the expert.
what we're looking is for things that are, horribly deficient in health and safety reasons. Reasons we want to run away from the property, and we use a term. We're looking for a house with all the right things wrong with it. In other words, when you buy a used house, there's going to be something wrong. So we want to make sure there are things we can handle. And I always like that home inspection report. I call it my Home Depot honeydew list.
Yeah.
So the honeydew list is things that we're going to fix over time. And in a few situations, we may ask the seller to make a repair or two, and that's a separate negotiation.
Yeah.
But once we're sure that, this is the house we're going forward with.
Yep. And then he gets me that information back before we kind of order what's the next type of inspection called an appraisal. But that private inspection one that they run is the very most important because it tells you, hey, do I want to move forward with this property based on the standing that it's in right now? What the next report is called an appraisal, and that's ran and done by the bank, and that's to verify value. They will do a house inspection, so the appraiser is also a licensed inspector to be able to tell you, hey, are the bones good, are the skeletons good of the home, is it pipes running well, is the foundation looking good? But they're not going to go into thorough detail the way an inspector would for your private inspection, because that is for you. The appraisal is there really to just verify, hey, is the home in health and safety? Is it in good condition that somebody can live in right now? And based on all of the sales around that same neighborhood and that community, does it meet the value that you guys have agreed to on that purchase contract? Because if, let's say, for example, all the homes around you have sold for $900,000 and the contract comes in and we see the contract at 100, or let's just call it $1 million, and we have about $100,000 gap between all of the other comparables, well, the appraiser is going to try to find, well, why are they agreeing to $1 million on this property, and try to find value and give you that value. That's the most important on the appraisal, is trying to get to that point of where your contract has agreed upon that purchase price. We don't typically see too many appraisal gaps. We've seen probably the most we've ever in a short period of time because of the type of appreciation run we've had the last 2 years because of the pandemic, which caused values to just increase so fast. So it was hard for appraisers, right, to keep up with, hey, the time value changing. Why can this home go for 5% more just a month later? I mean, it was a very fast appreciation run up, but we typically don't see too many gaps. So right from there, right, you get the offer accepted, you do your personal inspection within the first 3 days, you guys tell us, hey, you think the property's in good standing, boom, we order the appraisal. Why do we wait? It's because you don't want to pay for an appraisal if you know that your inspection is going to come back bad. What if Kevin was like, hey, Garrett, don't order the appraisal, the foundation's cracking, we're moving on to another property? Then boom, we don't want to order that appraisal, we wait. But let's say the house is perfect, right? And Kevin's like, yeah, we got a great house. We're going to order the appraisal. We're going to get that appraiser to hopefully match that contract price or get very close to. And then what we do from there is the underwriter verifies with all of the title documents that the title company is captured and the escrow company to verify, hey, who's in legal right to purchase this home? Who's in legal right to sell the property? If those two match up well, great. Then we can move on and underwrite the actual property. So then the underwriter is going to verify the appraisal, make sure that the appraiser company is a legit appraiser within San Diego or wherever we're buying. Going to make sure that the comparables match, make sure that the type of appraisal reporting and the type of way that he reviewed the property is correct for the type of loan program, because there are different types of appraisals depending upon what type of loan program you're getting even. So the appraiser has to look at other things for different types of loans than they would for others. So then the underwriter needs to make sure that the appraiser looked for lead and looked for paint on an FHA loan, as opposed to they didn't really have to do that for conforming. And so the underwriter verifies that they've done it specifically to the type of loan program, and then they give their green light and check, or that stamp of approval, just like they do on a borrower, saying, all right, boom, here's your approval, borrower. If you can provide us these conditions, then we can absolutely get you final approval. They do the same thing on the appraisal. They stamp it, they say, perfect, this is approved, but they might want to see a couple tweaks. Let's say that there was termite rot, or there was lead paint issues, or there was peeling paint. Well, then the appraiser might say, this is approved. Conditionally, we need you to go out there and repair the termite damage. We need you to repair the paint. We need you to make sure that the windows are all secure. We need to make sure that the water heater is double strapped. So they will still give you that approval, but it will be conditionally based. And then what we do from that point is we get that information to you right away, obviously. And then Kevin and the listing agent, right, will go back and negotiate, hey, what repairs can we get done ahead of time? They might circle back to me to say, can we do these after purchasing the property with money held into an escrow account? Whatever the solution might be, we just will get that approval on the property, and then we have to meet those conditions that the underwriter gives from the bank so that we can purchase that property with a loan.
Good.
A lot of hand gestures there.
A lot of hand gestures. Well, there's a lot of moving parts there. So one thing is, first of all, make sure that you know that just because the appraisal was done and they got the price that we want, doesn't mean that it's approved. The appraisal still has to be reviewed by the underwriter to make sure, because we've seen underwriters, not recently, but in the past, where they kind of go back and nitpick things and like, how did you come up with this value? That doesn't make sense, and they'll actually require a second appraisal.
Correct. Very
rare that happens, by the way. And also on conditions. And you could have some conditions where I've known in the past where it's like a 3-bedroom, 2-bath house. One of the bathrooms is not operational, but they have one that works. So you got an operational bath. The appraiser probably is not going to bring value for the second bath that's inoperable, but if the value is there, and then the lender's also going to then look at that borrower and say, well, are they going to have any money after closing escrow to fix this? And if they do, okay, they may consider doing that. So just don't assume that they will. But again, talk to Garrett. Garrett talks to the underwriter. They kind of hash it out to come up with a solution. Let's go down a separate little bunny trail, as I like to do. We're talking single-family residence now. What are some of the property qualifying things that we look for in condominiums?
Oh, great question. So difference between single-family and we talking strictly appraisals, or just different types of overall underwriting?
Well, for the overall underwriting. So if I bring this couple and they are buying a condo, in addition to doing the appraisal, in addition to looking at the title report, what condominium documents or conditions are you looking for in order to approve? And let's keep with a standard loan, not FHA, VA.
Yeah, conforming. The vanilla loan. I like that. So brings up a good point, because fortunately, condos are verifying a step further the type of condition that the overall complex or structure of your building is in, whether it's internal or external. So not only does, for example, when we do a appraisal on your property, and if this is like we're buying a condo or a single unit, right, inside a condo, you're going to get an appraisal done just on your one unit inside that whole complex. But what we as the lender have to do is called pull condo docs as well. So we have to reach out to the HOA, we have to reach out to the condo association themselves and collect their entire condo documentation, which will include things like inspection reports for all units that have been done in the last 12 months, any type of outside maintenance that has been required or done by other units. And then we'll also very much be diving into the budget of their condo to confirm that they're collecting enough in HOA payments per month to meet the types of structural improvements that they're going to need further in the future, the types of maintenance that they require on all of their properties. So if their budget came to us and let's say they were in a deficit, then we would unfortunately not get condo approval and we wouldn't be able to purchase that home for you. But let's say we've got it to a condo and the budget was at neutral, right? So they were making just enough to pay for all the expenses that were right there. Well, then what the underwriters might do on a conforming loan is they might look, well, is there going to be any, and they'll work with the condo team to see, hey, is there going to be any type of special assessments done for all the people in the units? And a special assessment, just think of that as an additional HOA payment per month, because what we can identify in the budget, if you're at neutral, that typically means there's going to be a special assessment or an addition to your HOA payment to make up for either the lack or the deficit of the budget, or they're anticipating other things needing to be done on this unit, like maybe a new roof needs to be done on this specific building with this unit, or maybe all the buildings need to have roofs done, or there's concrete slab foundations that could be falling or whatever, and that will be seen in this condo report. So we do have to get a condo clearance, meaning typically about 20% or greater above the total expenses. Easy vanilla loan, we're going to get that approved for you. But if we see that the condo budget is in deficit, or that there's a ownership ratio that is greater or is less than 50%, meaning let's say for example there's 100 units in this complex and 50 of the units are owned by a person living there, then great, we can automatically approve it. But let's say those condo units are actually the opposite. Let's say 50% or more are renters in that condo complex. Well, then typically we got to do another verification step to be able to get you a conforming loan, because the investors that buy all these loans that have to get condo approval don't like if the condo has more than 50% renters on the property, because that's seen more as a risk of that complex not being as well upkept. So lots of rules there, right? But the biggest piece is that we have to verify that the condominium is in good health and safety standards, that the condo docs are in a good place with their budget, and that there's no other type of outside litigation potentially on the condo right now. And if we can pass all these different inspections and these verifications on the report, then we can get you a conforming loan. So we do all of that in a time frame of about a week to 2 weeks it takes to get all that information.
Yeah. So again, this is kind of behind the curtain that they're doing all this, and it's usually not Garrett. It's his team.
Big team.
big team behind him there that's doing all that. So a couple of quick notes of condominiums. Again, when you think condominium, remember it's joint ownership, condominium. So you're owning this building with everybody else. So that's why they have to look at that. One of the reports they're going to look at is called a reserve study. It's supposed to be done every 3 years. So they're going to look at that and go, how much money do we have socked away for that rainy day? So that's part of what, when Garrett says neutral, in other words, we want it to be positive. Do we have some or most of the money? Probably the worst case I ever saw in a non-broken condo. It was one of my listings, and it had less than $1,000 in reserves, and it was an old building. So it was like, yeah, it was that was a tough sale.
That means those owners are going to get a special assessment fee, pretty big, probably.
Pretty big, because all it takes is one roof to blow off. Everybody's responsible for every roof in the complex. So even though you're not in that building, you got to pay for part of that, and you got to cough up the money now. So those are the risks that the underwriter's looking to avoid having the lender have, and also the borrower have. one of the other numbers is what's the percentage that one entity can't own more than 10 or 15?
10%.
10%.
10%.
So let's say one person goes, I love this condo project, and they go and buy 11 of those 100 units. They have more than 10%. Most conventional loans will not make a loan in there. So that's one of those key things. So if you're a real estate agent and you're looking at a condo, the things you look at is there more than that? What's the owner occupancy ratio, and are they in litigation? You know, and that's always those are the part of your qualifying before even showing them to the property.
Yep. Hopefully the listing agent has done that for all the buying agents, right?
Hopefully they have, but remember our bar of entry is way too low, in my humble opinion. So the other thing with so we talked about that the home inspections up front. Isn't the appraisal an upfront charge also?
No, appraisal, yes and no. Great question, actually. We can charge the borrower, but also direct lenders like ourselves, we can actually pay for it on our internal credit card and pass that cost just on to you through the close of escrow.
Through the close of escrow.
So when you only have to wire your money in at the end of the day for your deposit or in your down payment and closing costs, we would just add that cost to your down payment, and we typically will take that initial investment up front for you.
Okay, so there's that. And one other magic thing that happens sometimes in qualifying the property, and we just love it, an appraisal
Property inspection waiver.
Property inspection waiver.
Those are the best. So property inspection waivers are given by Fannie Mae and Freddie Mac, which are the two largest investors and guideline creators for our entire industry. They have been, around forever, and they're the ones that kind of set the standard of what can and can't be done in the mortgage industry.
Right.
So they have more loans than any other investor out there, and they've underwritten more loans than any other investor. So they know, let's say you're just in a typical community or suburb, right, in San Diego, they're gonna know, well, hey, the neighbor next to you that has a Fannie Mae loan probably, or the neighbor next to you has a Fannie Mae loan, and they've all done transactions, everybody's done a transaction in San Diego roughly within the last 2 years because of either where rates have been moving down so fast and now back up so fast. So Fannie Mae and Freddie Mac, right, have a lot of data right now.
Ton of data.
So they know exactly the value of your home comparative to the neighbor right next to you that just did a refinance or did a purchase. And so if we have a lot of data around a certain census tract, Fannie Mae will just say, you know what? I see Kevin said we're buying this property for $1 million. Boom, we agree that the value is $1 million. Waiver given, no appraisal needed.
No appraisal needed.
That is such a good news. Now that doesn't mean you don't want to do your property inspection, right? You're still going to do that first one with Kevin because that's going to tell you the bones and the pipes. But this property inspection waivers come in and just to say, hey, at the price that you've guaranteed that you're going to buy the home at, we agree that the value is at $1 million. So that typically kind of means, I like to always say, if you get a property inspection waiver on a purchase, you're probably buying the property under the value of the home because Fannie Mae and Freddie Mac are, they're working on data that's 30 days behind typically on transactions. So I like to, if you get a property inspection waiver, you should look at that as really good news, meaning you've already bought in a home that Fannie Mae and Freddie Mac think, hey, the value is absolutely there.
Because they're not pie in the sky. They have their own conservatism that they're cooking into that. So, and that's obviously one of the big contingencies in your transactions that gets taken care of right away, day one, and that's going to make everybody in the transaction feel a lot better. Now, on the other hand, you can't use that as a contingency to get out.
Yeah, correct.
It's like you're in at this point. So, well, outstanding. So again, we talked about how to qualify the borrower, and qualifying the property is as important. Not as important because if the property doesn't qualify, throw it away and go find another property. But we're going to keep the borrower.
Yeah.
And as you can hear, there's certain safeguards for the borrower that get built into that too. Whether it's a condo, whether it's a single family, someone else is looking at the condition of title, and so forth, because they have a vested interest. They want to make sure that they're writing a good, safe loan that the investor will agree is a good, safe loan.
Yep.
So.
Absolutely.
All right, thank you.
That was awesome.